This is Eat, Sleep, Invest, the marketing podcast for real estate investors to get more deals.
When people are doing, short-term buy-sell agreements, one of the things that people will do, the one thing about buy-sell is that there's a couple of ways to do it. You're protecting, obviously each other against the event of the other person's death. There are a couple of carriers that have very competitive annual renewable term, right? So if somebody wants to, says, I only need this protection for 2 years, they're very competitive rates for what's called annual renewable. So it'll be X 1 year and it'll be a little bit more in year 2. Now, you wouldn't want to keep something like that for more than, say, 5 or 6 years because those premiums are going to balloon. But if somebody says, no, we're out of this deal in 3 years, but we want to have this coverage, that's a very competitive way to do it. The one thing we do also is sometimes people who are inactive, are constantly doing these deals. The other thing you could do is buy a term life insurance policy so you're not reapplying for each new deal. So you may want to buy a term life insurance policy that's a longer, and then what you can do is you could go so far as if you wanted to, you could actually transfer ownership, right? So if you and I are doing a deal and I have a policy and I say, okay, I'm going to transfer ownership of this policy to you and make you the beneficiary while we do this deal. At the end of the deal, you transfer the ownership back to me and I change the beneficiary back, right? So I have this term policy that is for that purpose. It's waiting. The next deal that comes along, I'm going to transfer the ownership and then change the beneficiary for that deal. And what that would mean is that I'm not trying to get underwritten every time. I've got really quick reactions to that.
You know what? That's a good point, too, because the average life cycle of applying for insurance to issuing a policy might be, like 45 days, give or take?
That's a pretty good average.
Yeah.
A lot of carriers, I would say that we do it in a lot of circumstances, it's gotten very fast. But as soon as there's a medical anything, right? It doesn't have to be major. As soon as somebody's on a prescription or had appendicitis 2 years ago, little things that are not going to impact the policy, but are going to make an underwriter ask more questions. Those are going to be the things that are going to push it out to 30 or 40 days.
Yeah. And it's a pain in the butt, too. That is, I never thought of that. You just have a policy sitting there for your flips. When you partner up with someone, put them on as beneficiary. When it's done, you're done. It's just a simple form.
Exactly. And that's where it's funny because that's also where a permanent life insurance policy can become, advantageous as well. You would use it differently. You don't take your permanent policy and make somebody else the owner of it, but you could put them on as an assignment or as just a beneficiary. Right? So you could change that. But the thing about a permanent policy is now there's no, like if you buy a 10-year policy, you know that if you're going to continue doing this in year 11, you're going to want to get a new policy. If you say, I have a 20-year run in front of me, do I want to do a 20-year term and keep that there? Or do I want to do something that's permanent? And then what you would do is simply evaluate, how could I, what's the value I have of that cash value, right? Do I like the idea of having that be my savings account and that this death benefit's here so that I can just, have different people assigned or beneficiary for a portion of that death benefit? So there's a lot of ways to structure that so that people can, make what they're doing easier and sometimes more efficient.
Yeah, and the reason, for anybody who doesn't know buy, sell, and why you would even do that, it's like, say me and Ian are doing a deal, and something happens to me. If we don't have anything in place, most likely my wife just became Ian's partner with no experience in real estate or business. So you can buy the life insurance policy, which buys the other person out or buys the other person's spouse or whoever would inherit their stuff, right? And then you get complete ownership.
Yep, it's a great piece of protection, and it's a way that people keep everything in line. And I've done it for people who, there are groups that have put together, buying consortiums, right? So they're all coming in, and there's the superstar or the driving force behind those. And that's usually the person who's doing the raise. They're out there asking and say, hey, this is what we want to do. This is what we're going to do. And they're like, great, I'm going to put that money in place and do that with you. They're really buying that person's knowledge and expertise. And if something happens, they'd like to make sure that they're covered. So if the guy that they were funding and who was doing all this stuff, who knew how it all worked and that they already trusted, something happened to them, they'd like the idea that, hey, that bucket's going to get refilled. I'm going to get at least my money back, right?
Right.
And they could build that however they saw fit.
Hey, Ian, what else do you see real estate investors using life insurance for? Like, I know there's a lot of creative things. What do you see as most popular or most common?
Well, the one thing, there's a couple of aspects. So using the cash value of life insurance for down payments and things like that. Now, it takes a little bit of time to build up the cash value before it has the steam to do that. But it's interesting. When I talk to, clients who've had products in place for, say, 7+ years, and you go over everything you can do with the cash value of that contract and the ease and the speed and what goes on with it, a lot of people like to use that cash value to have that in and out aspect of what they can do with that cash value. And you and I were talking a little bit before we, started about, all the bank on yourself, infinite banking, be your own banker type of stuff. And that's really what that comes down to. It's basically building up the cash value of your contract so that you can access it and pay yourself back, right? The idea being, and since, you have a lot of real estate people who are listening, the idea being is that your policy in that particular circumstance is like your real estate. It's just continuing to grow. So whether you're taking loans against it or drawing equity out of it, the policy's value is continuing to grow. It's basically collateral. So for example, if you had a piece of property and you went to the bank and said, I want to leverage this property to get cash, to take a loan out, that property's value is going to increase. The property doesn't know there's a loan on it. It's not going to behave differently or act differently. And that's what all those, all those fundamentals in terms of be your own banker, bank on yourself, and infinite banking, that's what they all focus in on, is that same idea. Because what you're doing is your cash is in the background constantly earning, and what you're doing is using the insurance company and the way their contract works to access cash on an in and out basis. So you'll hear me talk often about when people talk about whole life insurance. And again, the reason whole life insurance tends to come up in those conversations is because of its stability, right? There's no big swings.